You know, by virtue of my position at the Capital Match Point, I have the opportunity to talk to entrepreneurs on almost a daily basis, entrepreneurs that are seeking capital in various stages of funding. And one topic that our conversation almost always gravitates towards is, what is your company worth? And after we talk for a few minutes, the answer usually comes back as something vague, or maybe just simply I don't know. And you know, one thing that I can't stress enough is that you, the entrepreneur, regardless of what the investor is doing, because they're going to form their own opinion on what your company's worth, but you, the entrepreneur seeking funding, have a very fact-based, analytical opinion of what your company's worth. Now, valuation, admittedly, is as much art as it is science, and everybody has their own way of doing it. This investor will think that something's important, and this investor will think that something else is important. So what I generally recommend is that you take at least 3 methods of valuation and look for convergence around a number. And chances are, if you get convergence around a number, you're on the right track. Now, whether you like that number or not, I don't know, but it means that you're on the right track. And again, there are a lot of different methods of doing valuation, but 3 that I would recommend, because they're widely used and all of our investors will understand them, is the price to earnings ratio, the price to sales ratio, and the discounted value of the price of the cash flows. Now, the price to earnings ratio is going to require you to go out and do some research on publicly traded companies in your market space. Find out what kind of price to earnings ratio they're trading at, compare it to your company, and what you think the appetite the market will have at your time of exit, and make your valuation accordingly. Price to sales is done very similarly, except that instead of earning the price, instead of the price of your stock to earnings, you use the ratio of the price of your stock to sales. This method is used a lot in sometimes immature industries that don't yet have a clear path to profit, but in industries that do have revenue, it's almost a surrogate way that the market uses to assign value to a company. In the discounted cash flow method, what you need to do is make some projections about your company's cash flow out into the future. 5 years if you can, 3 years minimum. Discount those cash flows back to the present, sum them together, and arrive at a value of your company. Again, your opinion and the investor's opinion are going to be different. That's okay, but you need to be armed with something to negotiate with. Or if you'd like some help in establishing a value of your company, get in touch with us at the Capital Match Point. We're here to help, and we're here to maximize our clients' chances of getting funded.